Hello everyone. We will start in 1 minute. This is the last module this year, and today we will talk about everything. Okay, let's begin. So this module is devoted to the advanced trading simulation and automation. As usual, I need to remind you that this is not an investment advice. We do have an educational project, and please use everything that you learn with cautious. Hopefully everyone knows me. I'm Ivan Brigida. I'm a business intelligence analyst at Google, and I founded a pythoninvest.com website where I host this course and analytical articles about investing to stock markets. So today we will cover a few things. First of all, we'll look at the home assignment number 4, key concepts covered, your comments, and time spent, and compare these versus previous year. Then we'll talk again about the system design view, and this time this is the latest step number 5. But before we move on to the automation piece, which is step number 5, we will talk a little bit about the advanced simulation. Previously, we covered simple simulation, where every prediction, every positive prediction where we decide to invest results in one trade, so that we have endless capital. We don't have any other advanced features like time of entry, stop loss, or take profit logic, and we can simulate it with the vector-based calculations. That means very quickly in Python. This time we will deal with the limited capital that you might have, and this functionality will cover day-by-day simulations. So we can't do it in a vector form, because at any given date we do not know how much capital do you have in place, because every capital that you invested, every piece of capital that you invested previously will be used for reinvestments. So you might get gains or losses, and that's a different setup for everyday trading. So this will be the first part on simulation, and then we move to automation. Automation usually is the later stage of your project, when the research phase is finished and you wanna move to the automated execution or a production ready project. So we will discuss how you might want to convert Colab notebooks into a Python project, and I will show you what I created in my local environment. We will build a data workflow that is one file that orchestrates and calls different functions to download data, transform data, train the model, make predictions. We'll briefly discuss the local development in Visual Studio Code. This is especially important this year, because it makes it easier for you to use AI assistants if you use an IDE and not use a Google Colab, where AI assistants are not that good yet. We will run the workflow from the command line, and I will show you how to run it via automated environment. And finally, we will talk about serverless. That means that you may not even need to rent your own server or have your own machine that is always on and that is running your code every day. And you can deploy your project for free using GitHub Actions and Streamlit. Then we'll recap everything that we've learned, and finally we discuss Capstone Project requirements. So let's begin from the system design view again. This is the 5th time that we see this image, and we started from module 1, where we combine different data sources and discussed which features you might want to get from those data sources, and as a result of that module, there were a set of files or tables that you can generate. Actually, today I had to use other sources not covered in module number 1 because Yahoo Finance was not available from my location. Sometimes, as I understand it, there are rate limits imposed by country, so I could execute data. I could execute Colab from the US servers, but not from the Irish servers. So even now, during module 5, I had to implement other input sources to make it working. Then during the module number 2, we discussed how you might want to combine those separate files or tables into one big flat table, and how you want to make adjustments to the features, define new features, and split all of them into several sets, like all numerical features that you use for modeling, all categorical features converted to dummies, etc. Then we tried different ML techniques and produced several models. The best models were random forest and decision tree. I also showed some code how you can create a logistic regression or a deep neural network, but you need more data for make it working and more time to play with different hyperparameters to tune. Last time we came up with a trading system that is we built predictions from different models and created a simple strategy to invest in every positive prediction. We simulated that strategy and got some result. And today we will start from the previous part, and we'll build the advanced simulation, which is closer to the real world. And then we move on to the automation piece, how you can automate everything in one workflow. You can also deploy this somewhere to the cloud servers using Docker or any other tools you might want to use. We are not covering this in this course, but I know that many of you actually finished datatalks.club courses, other courses, and you may know how to do this. As usual, you can still join at slido.com and ask questions with the hashtag SMA. I see that not many people are asking questions there. You better ask your questions in Telegram channel or Slack, where there is some discussion. So now let's see what we have with the homework statistics. I presented first 3 home assignment stats last time. As you can see, that this year we have slightly lower submission numbers. As expected, fewer people submit all home assignments. I understand that it requires a lot of time, and strictly speaking, you're not have to submit all home assignments, so you can just create a Capstone project and do 3 peer reviews, and you'll get a certificate. For homework number 4, we have 21 versus 31 submissions as of today. You still have time until the end of day today, a few more hours, and same median time of 5 hours for homework. If you didn't try to solve this homework, I want to share the core ideas that were covered in the homework. So this time you were asked not to develop anything from scratch, but you were asked to copy the notebook, a Colab notebook, and make some changes. Usually it's one or a few lines of code, and produce the results of a simulation. That is in many cases to find the best annual growth rate of your portfolio. And there are a few ideas that were covered in this homework. First is that less features is more. So we generate a lot of dummy variables during the training exercises, and some of them are probably not that powerful. For example, we have dummy variable for a month or for a weekday, which should cover the seasonality that oftentimes happen with the stock markets, but around 60 dummy variables that represent a combination of a month and a week of a month are not that necessary for the modeling piece, but they add a lot of noise to the data. So this time we try to remove these features and run the whole system to see if the whole system is working better. So now you can see that it's not only about training one particular model and optimize an accuracy or precision, but it's about how you can improve the whole system, or how you can predict the average capital growth per year better. The second idea was to use a random forest model and find the best average growth for the random forest model. And here I asked you to define more threshold rules and see that when you define a higher threshold rules or higher probability when you select positive traits, you end up with less traits in the end, and potentially higher or lower growth of a capital, because you might lose some of the traits that bring your capital to the higher growth rate. And finally, there was a question about the predicting of a strong future growth, and that is if you are predicting not just positive or negative growth in 30 days, but you can define some number of a strong positive growth. Say in our case it was 8%. So if a stock was growing about 8% in 30 trading days, that is roughly 1.5 months, then we define that that was a positive growth in 30 days. And the idea was that if you make those classes of positive and negative slightly unbalanced, and you will have a fewer observations for a positive growth. In this case, it was about 30 or 40% instead of 50-50. It may be easier to predict, and you may be able to predict better the strong positive growth, because around the days or around the cases of a neutral growth, when it is plus minus 0.1% or plus minus 0.5%, there are many such cases and it's a lot of noise. So we want to filter out those cases and focus on a strong future growth. And it turned out that in this case of 30 days prediction, the strong future growth doesn't lead to a higher average capital growth. So we still live with the first idea that we predict only positive growth, which is more than 0% growth in 30 trading days. Actually, one of the questions was about your ideal trading strategy, and I see there were a lot of brilliant ideas, and I think I will cover most of those ideas in the advanced simulations today, but I want to share those ideas with you so that you can be inspired for your capstone projects. So someone said that they want to select 3 best and 3 worst predictions and have a leveraged portfolio to make investments. So I was thinking about 3 worst predictions last year, and I even tried to do that, but I think that if you want to predict 3 worst predictions, you need to design a separate model for predicting negative growth, because we are using decision rules to increase the precision. So that's not the same model trained where it predicts positive or negative class and we use it straight away, where you could take top 3 best and bottom 3 worst predictions and use for the long strategy and for the short strategy. But of course, it's a solvable question. You can do this. And then someone else suggested to use a 2-tier approach, where they want to combine a random forest predictions with a decision tree predictions. So the idea here is that we may have several models, and we are not selecting only one model to work with, but we can combine somehow the predictions from those models. And also I saw that many of you think about maximum 1, 3, or 5 trades per day, a stop loss for a position, so that it's still semi-automatic algorithms for trading. We want to manually check what you see in the predictions. So that's why one of the criteria for the efficiency is not only precision or average growth for your capital, but actually the amount of time or the number of trades that you make per day, because you might be able to reach roughly similar average capital growth with the fewer trades per day. And then many of you understand that when you're moving thresholds higher, you want to focus on a higher probability of return, and you want to do smaller trading just to limit losses if things don't go well, and use simple base rules like trees that we want explainability in the trading that we make. So some of you described in precise steps what you want to do with high confidence predictive signals, with momentum and trend indicators, adding additional metrics from the options market to do sentiment and volatility, define stop losses and exits, and trade smarter. That's easy to say but hard to do. I think almost every submission was about balancing precision, diversification, and risk management. So there were a few more ideas like dynamic capital allocation, where you actually place a higher bet when the probability from the model is higher. So on top of the decision rules, you may want to do a dynamic capital allocation and slightly put a higher bet on a higher probable trades, but it's all need to be simulated. Then limited number of trades, that will be simulated today as well, and risk management. That's all the same ideas. Okay, and that were the ideas that you shared in your homework. And now let's look at the advanced trading strategy. So the core concept is that we iterate over dates. That means that we take one row of data, and that is essentially one ticker or one company and a lot of features. You send those features to some function that knows some other stats like capital that you have today and that you want to invest, and some additional stats from the future when you want to test whether stop loss or take profit strategies will happen in the future. So we are introducing the, new things like risk management, that is stop loss and take profit. Top K, that is we are not trading all positive predictions like 33 or 20 positive predictions, but maximum 1, 3, 5, 10, whatever K stocks. Then we define a different entry size and we define a different timing. That means that sometimes we want to buy lower than the current price or buy higher if the price goes up from the moment of the prediction, and you still want to support this bullish or growing trend. So for today's session, we will be using not the best predictor that we had. That was a predictor number 9, which was a one decision tree with a high threshold rule 92. That is, the probability should be 92% for a very few trades to invest. The reason why I wanna use random forest, that is predictor number 10, and here you can see that it's about 10% of growth, of average growth per year for this predictor. So the reason why I'm using random forest and not a decision tree is that it is a more robust model. So it's my personal preference that random forest is actually an average of many decision trees, and it should work in many environments, and I trust this model more because I see big variation of predictions, and the predictions are quite smooth. That means that it's not like all the data points are split between 20% and 99% prediction, but I could see the predictions of 50, 60, 70, etc. percent, and that means that it actually aggregates the predictions from many decision trees. And I think that in the worst case scenario, when something new and unexpected appears in the data, it should behave better, but it's very hard to test. So again, we're using prediction number 10. The problems with the basic simulation or the best result that we had, predictor number 9. So the best result was 15.5% of average capital growth. We had to do many trades, on average 14 trades per day. We couldn't know what capital do we need. So it could be the case when you had to do 30 trades or almost maximum of 33 stocks that were all predicted positive for the 30 days in a row. That means that you should have a lot of capital to secure for those trades. And sometimes when everything was not growing, you might not have even 5 trades. That is that you would have your capital not efficiently used. So the major problem was a poor capital utilization. So the second problem was that we didn't use capital gains, hopefully, and not losses for reinvestment. So if you have 15.5% growth in 4 years without reinvestment, that is every year you add 15.5% to your capital, and in 4 years it will be 62% of additional growth to your capital. And now you can compare with the power of a complex percent where you reinvest all your capital gains, and every additional penny that you get, you will use straight away for the trading, and the result will be 78%. So it's 1.15. You multiply 4 times, and that's what you have, that you will have 1.78. So that's a big difference, especially if the growth rate is not like 15%, but even if it is 10% or 5%, you will see a sizable difference. And finally, we were assuming that all bids from the close price were filled. So the way I originally started to use that system was that I made predictions when the market is over at night, and I tried to execute the predictions on the next day when a new trading day was open. The thing was that the difference of an open price and the close price may be very high. So sometimes it was minus 5%, plus 5%. So it was essentially a different asset. And if last year we were predicting for 1 week ahead, and if you could get, say, 3% of gross return in a week, it was a successful trade. But now, just because of the price volatility from opening for the next day and close of this day, all your profit could be gone, even if you were right with the predictions. And finally, we want to reduce the number of trades per day. Okay, so before we dive into the prediction function, I want to introduce several new things. First, we want to rank all the predictions and store those predictions as a new column. So we're using predictor number 10, and it is predictor 10 underscore rank. And you can see here that they are all ranked decreasing. So 0.72 is the maximum prediction for that date, and rank number 5 is 0.769. And if you take a decision tree, a single decision tree predictions, the predictions will be completely different. And I like that predictor less, because oftentimes I saw that it's either 0.98 or 0. So maybe it was a too simplistic model. Maybe it is something that you want to see from the trading model to explain the world around in simple terms and be able to separate perfectly 0 and 1, or positive for and negative predictions. But I think the world is more complex than that, and that's why I'm generating rank for every day. And if you're new to Python, you can use this function, this method, group by date, define column name, and rank by method first. So we define new column name predictor 10 underscore rank, and this is a formula that makes vector calculations and assigns every record a specific ran during that day. So okay, let's look what we see in the code. So you can define as many columns as you want. It is one line of code, and immediately you can rely later on this column to make simulations. And what I wanted to highlight here, that a decision tree in the way that we trained, that was not a very complicated decision tree. It has only two classes of predictions, whether it is a very small probability or very high probability. And for the random forest, and the probabilities are more smooth. So that was ranking predictions. The next thing is when we try to buy cheaper. And the parameter that will be used in simulations is called lower_entry. And it can be lower, it can be higher. By default is that if lower entry equals to 1, that means that we predicted some growth of a stock, and we see its closing price for the day before, and for the next day we place a trade to buy that stock at a price not higher than the close price. That is close multiplied by 1. So buying maximum at 100% of the prior close price. If lower entry is 0.99, we try to buy cheaper. So probably the predicted stock is still not at the bullish at the bullish range, and not everyone is buying it, and you could buy it cheaper. And if you can buy it cheaper and it will grow later, you can get this additional 1% of returns on your account. But the thing is that some of your trades won't be filled at all, because if a stock is growing fast, maybe next day the lowest point is higher than the closing data for the day before. And lower entry can be positive as well, that it can be 1.02, where you say that I am ready to buy that prediction on the next day, but maximum price that I'm ready to pay is 102% of the close price. So here you can see the example. That's from the last year, where we had adjusted close column and not close column. And here you see that, let's assume that Apple was predicted to grow on the 24th of April, and you wanna buy it next day. And you can calculate during the simulation phase the minimum value of the price on the next day. That's why it's called min_low_next_1, and the minimum value is 168. So your order will be filled for 1 or 3, because if you're ready to buy it 169 or 2% higher than 169 is 173. But if you want to buy it cheaper, 1% cheaper, or roughly $1.7 cheaper than 169, you won't find any minutes in the next day, because the lowest price was only 168. And another example, let's assume that you're now making simulation for the 26th of April. Your close price is 169.3, and you have same three rules, and all of them won't be filled, because the lowest price on the next day is 173, or it's about 2.7% higher than the close price before. So you might want to think that if Apple is actually growing that quickly and that fast, maybe you want to buy it, or maybe it is too expensive for you to buy. And we want to simulate different options for the lower entry. Also, I solved this problem with another idea, is that algorithm, the whole algorithm was working over maybe 3 or 5 minutes, and I started to do it not on the after the markets were closed, but during the trading hours. And if you do this normally, let's say it's a 24th of April, and adjusted close data from the Yahoo Finance or similar data sources will be some lagged or 15-minute lag value of a close price for the stock, and usually it's not very different from what you see. So it's not that different from what you might see for the next day when the market is open. And utilizing this approach, I could make predictions during the mid trading day, and I didn't have that many bits unfilled. So here is what you see. You can define a ratio. What's the distribution of the lowest price for the next day versus closing price of today. And the distribution looks like this, that in many cases it's around 1. That means that the stock is not growing or declining that much, and the mean is actually 0.98 or 0.99. That is that's if you have some close price defined and you wanna trade that asset next day, you should be able to do this in many times. But sometimes let's see that sometimes stock can grow up to 20% in one day, and now you definitely need to think twice whether it's a one-day spike or you're still confident that this stock should be growing. Or for example, if next day the minimum price is minus 28%, or you see that when the market is open, it immediately goes down more than 2-3%, that means that something is happening, and you may need to run the prediction again. The second parameter is a stop loss. So I know that some of you asked to make a separate lecture on financial terms, and I'm trying to explain the concepts or the ideas that I have here, and hopefully you can find those concepts in anywhere in the internet if you need more guidance on them. So stop loss is that you want to cut your losses if the price drops by 10 or 20 or 30%, whatever percent you define in the next 5 or 30 trading days. So 5 days was last year, 30 days is this year. I didn't update this screenshot, so here you have only 5 days, because for 30 days it would be quite complicated to show on one screenshot. So let's assume that stop loss equals to 0.9, and it was about 1% of records that had losses more than 10% last year. And if you define a stop loss 0.8, that is minus 20%, for the longer prediction interval, that is 30 trading days, you will have 3.5% of records statistically where this stop loss might happen. And how you do it, when you place a trade to buy something, you can add additional connected settings for the trade, and different brokers or APIs deal with it differently. But usually you say that I want to buy say Apple here at a limit price of 173.5, and I can attach a stop loss trade of minus 10%, so it's 155 to this trade. So if the price goes down, the system will try to execute the trade automatically and sell with a limit price of minus 10% to 173. So what we have here, okay. Actually, the example is for a stop loss which equals to 0.98, where you say that I do not tolerate even small losses, and if stock price goes down by 2%, then I want to sell it immediately. And let's assume that we bought an Apple stock on the 29th of April at a price of 173.5, and in our simulations, so you never know if it will happen if you buy it now or not, but historically you can calculate all of that. And in the simulations you see that lowest price in the next 5 days was 169. So you know that 170 is 98% from 173.5. That means that the lowest price was lower than 98% of the initial price, and this stop loss would trigger an event of selling your stock and closing the losses at 170. So it's not guaranteed again, so it may go down very quickly and you may not get 170. You may have to deal with the smaller money that you can get, or you may not feel at 170. So the trade will be placed in the system automatically, but it may be not filled because the current price will go even further down. The downside of this approach is that now we have 30 days of trading predictions, and there are many chances to recover losses for that particular stock in 30 days. And if on Sunday price suddenly goes down, it may be not the reason to sell it immediately. So that's the negative side. So the opposite the opposite parameter is a take profit. So the idea here is the same, and oftentimes it's a psychological thing that if you see that the stock is 20% up or 30% up, this is a big number in a few days, and you may expect that it can go down later, and you want to fix your gains. Of course, you may be losing further growth. So that's what we want to simulate. We will try different parameters of a take profit, and here we compare with the maximum number in the next 5 or 30 days. And here, if we had a 5% increase, so 5% from 173.5 is 182, but during the simulation phase on the 29th of April, we see that in the next 5 trading days, the maximum value is 187. So if you had a stop or take profit defined at 5%, that would automatically trigger a sell event, and you will fix your profits excluding fees at 5%. So that's the distribution of a ratio. Now it's data from 2025. It's max high next 30 days to close, and you can see that on average, and this is pretty high number because last 4 years, if you do it for the test split range, last 4 years were growing most of the dates. So on average it was 8% of max high next 30 to the close price. So that's the average volatility in the next 30 days. But sometimes stock can go up for 11%, 12%, or even 70%. So if you see stock going up on 30%, you might want to sell it straight away. So finally, we are ready to do this advanced simulation, and I will show you the code. This is code snippet number 2. Here we define a data class. Essentially, it's a one structure with a set of simulation parameters, and that's the initial capital. That's we have the threshold that's used for the decision rule. So we can vary on the threshold straight away and not use the many columns that we generated with the predictions. So one probability column is enough to simulate for many thresholds. Then fees, so usually it's 0.1% for many brokers, so for one trade. So here we use always 0.2% for buy and sell operation from the total amount. Then top K, that's maximum number of trades that we're making. Portfolio optimization, it's not implemented here, but the idea was that if you have top 3 or top 5 predictions that are positive, then you can simulate that you can generate optimal weights from those predictions in such a way that some characteristics of a portfolio are optimal. For example, maximum drawdown is not very big, or Sharpe ratio is highest. Then stop loss that we discussed, take profit, and lower entry. So this is the example that we use. Initial capital 10,000, threshold 0.55, fees 0.2%, top K maximum 10 trades per day, no portfolio optimization, stop loss minus 20%, take profit plus 30%, and lower entry that we're trying to buy slightly cheaper at 99.5% than versus closing price. So that's what we had, and the algorithm is like this. That's at every day we know that what capital is available today for trade. Initially it's 1/30 of the initial capital, so first 30 days is 333 every day, but later after 30 trading days you need to sell some position that you invested 30 trading days ago, and get some growth or losses if some money were not used, so there was no trade or no fill. you get you assume that you don't earn interest on those money, and you use exactly the same money that were on your banking account 30 trading days ago. So we select top K predictions. Here it's K less than 30, less than 10, but you can do whatever you want. It can be 33, it can be maximum 5. Then calculate weights. Here I assign higher weights for higher probable predictions. That's a debatable approach. It's called Kelly criteria, because we already filter the predictions by the threshold. So maybe we better do the portfolio optimization and try to combine those predictions effectively rather than relying too much on the model. But here I do slightly higher weights on the trades if the prediction is if the probability is high, and then I normalize all the weights so that sum of all weights should be equal to 1, and the capital that is available on a given date, say it's 333, is split among top K or up to 10 stocks with the specified weights. Then lower entry, we use this parameter 99.5%. That means that some of the bids are not filled, and we're trying to buy 0.5% lower to have a higher return in the next 30 days. Stop loss is 0.9, or maybe I used 0.8, so that's some number that you're comfortable to live with, and if your investment goes below that number you want to sell. Take profit is 0.2 or 0.3, so something some profit that you want to take immediately, and then we calculate financial result for all trades. This is the example actually from the previous year, where we had only 5 days of the prediction of wait time. So that's the date. That's all records in for that date. All records they had some prediction of growth 0.55, 0.59, and they have ranks. So here we selected top 10 predictions. Then calculated weights. So some weights, normalized weights. So that's what we want to do when we place bets. So it's normalized weights. For example, for top 1 rank, the probability was 59%, which is slightly higher than 55 or 56. And you can see that this trade had a weight of 15.8% versus others were just 7 or 8%. The thing is that just because of the lower entry defined, this trade was not executed. So it's step number 5, and maybe the stock was growing very quickly, and we couldn't buy at a lower price. Only one trade was executed, so there were no stop losses and only one take profit that could be executed if the trade was filled. And here you can see that's future gross return. Actually it's all the same numbers, but only one trade happened, and originally the investment was 229. We could buy it at a slightly lower price, but also there were some fees of 0.2% for buy and sell. So in the end, the closing price was 223, and future net return was 22.97. So that's what we have for 1 day in the code. It looks like this. So 1 day prediction, you can see where I debug all those predictions step by step, and that's a 1 day simulation function where I do all those steps and calculate returns for 1 day. So that's it. That's a 1 day investment. For 30 days it was 333.3. In 30 days it was 336.14. So small growth of this capital. Okay. So we could do the simulation for all days with this rep function. And now the parameters were like random forest model, threshold 0.55, which is 55%, initial capital 10K, fees 0.2%, stop K maximum 5 trades per day, stop loss minus 20% or 0.8. Take profit is 1.3, so we sell immediately if a stock grows more than 30%, and lower entry is 0.99. After simulation, the return was 7.7%. If you remember from the basic simulation, the predicted return was about 10%. Here you could get only 7.7%. Why is that? So the reason is that only 43% of bids were filled, because we were always trying to buy cheaper. That is cheaper on 1%. That means that not all of our bids were filled, and some of the cases when the stock was growing, or many of the cases actually, did not happen for us. That's why we lost some of the growth. So you may want to optimize that lower enter parameter. Now I want to show you the iteration over different parameters, and how we could grow the initial 7.7% to 13.9% of returns by adjusting those parameters. You see that there are many parameters, like only here there are 1, 2, 3, 4, 5 parameters. So there are at least 5 parameters, and you can define many numbers for each of the parameters that they may take. So my approach is that I optimize one parameter at a time. That's not ideal. It may lead to a local maximum and not a global maximum. So if you have a lot of time, you better just simulate over 10,000 or 100,000 of different combinations of these parameters, and make sure that you find the best possible average growth. So here what I had, first initially 7.7% on random forest, maximum 5 trades, stop loss minus 20% or 0.8, take profit 1.3, and lower entry 0.99. I tried to change lower entry from 0.97 to 1.03, and unexpectedly for me, the optimum number was lower entry equals to 1. So we can't fool the market. We can't buy cheaper or have some threshold to buy more expensive. We just say that at any given moment, if we predict that this stock is growing for the next 30 days, then our prediction is valid only for the current close price, and we want to buy not higher than that close price. But immediately the average growth was 11%. Then I optimized on take profit, so I tried to do it from 1.2 to 1.5, And again, the unexpected moment for me was that it actually says you need to select the highest take profit 1.5, or maybe you could try with 1.6 as well. And the thing is that it's not worth it that you sell at 1.2 or 1.3. So maybe if a stock gained 20 or 30%, maybe it will gain more. So that's why it said you need to have take profit 1.5, and CAGR grew to 11.9. Next, I tried to optimize stop loss, and I moved even further to 0.55 to 0.8. And I could find that when I tried to sell at 20% loss, or stop loss equals 2.8, it actually sold a lot of negative growth stocks, which later could end up at a better place. So overall, it's reduced my margins. So if I use stop loss 0.6, average growth was 13.19. And then I also iterated over a threshold. We defined the best threshold 0.55, but here I found that you could slightly increase your average growth if you select threshold 0.56. And finally, I iterated over these values for K, and when K was equal to 4, the optimal growth was 13.9%. You can see that exactly the same model, exactly the same predictions, but different simulation parameters could lead to a very different result. So you could see from code snippet number 5, that's the initial parameters, and I do one cycle and for different values, and I see what are the results. I try to control the fill bits percent, and what I have when a loss happens, what I have when take profit events happen, what's the starting capital, what's the resulting capital, what's the average growth. And every time I select maximum, so in this case it was 11.16%, and I started from this setting for the next stage. And at the next stage I tried to optimize another variable like take profit. Again, I found the best values, and finally I finished with these settings. So threshold 0.56, top K equals to 4, stop loss 0.6, take profit 1.5. And for example, say you don't have time at all and you want to trade only one trade per day. So what's the difference? Here I have a threshold. I think it's not 0.56 but 0.55. The ending difference can be tremendous. So that's here you can see that in 4 years, if you only make one trade per day, you may end up with 14.6k out of from starting 10k, and if you do 4 trades you can end up with 16.6. So that's a big difference in small adjustment. That's it on the advanced simulation. I know it's almost another session, but I believe this is very important, and this is as important as you carefully select all the input features and data sources, and as you carefully select the model. The way how you simulate is also the thing that you should spend a lot of time on. On the automation, usually it's a simpler step. So if you have all those steps defined via different Colabs or Python files, it's not a very long thing to do. That's you copy paste those Colabs into Python and prettify the code. So at this section, we want to run the entire process regularly and automatically. We want to generate predictions using the latest data, and advanced not covered here. You can also monitor system health and see what's the accuracy, precision, and trading results are done for everyday trading. And if it's deteriorating, then you may need to retrain the model. So the local project or the automated project is on a GitHub. I know it's not the best possible thing, and it's not a standalone GitHub repo. So sorry for this, but it's just a few files. So in the folder 0.5-development-and automation, you have a folder scripts, which has a few files, which is data_repo, train.py, and transform.py, where you do data functions, transformation functions, and training functions. Then there is a main.py, which is one Python script that calls all of the previously defined scripts. And I also have a local data, which is not saved to the public repo, but I save all the data in Parquet files. And I have a state for each step, so that at any given moment I have my input data, transform data, my predictions data saved in the folder. And if I say wanna run the prediction again, but I don't want to download the all data sets, the whole data set again, I'm just reusing the input stats that are already saved. And that's what you can see in VS Code. That's a main.py. I make it slightly bigger. And actually I used AI assistant to make some updates, so you can benefit from the enhanced commands and cleaner code. So from the last year I added more US stocks. Now it's 190 US stocks and not just 33 of US, EU, and Indian stocks. So it's a bigger data set. Changed from 5-day predictions to 30 days predictions, updated API calls, so you might saw that same Yahoo Finance library, it can be called via different methods, and I had to change the base call for the data because the data frame that it started to return became different, so it had multi-index and it's not very convenient to work with. And here you can see that I have stages, fetch repo, transform data, and train model. All are defined as true. That means that I want to have a slower workflow, but to run everything from scratch. So you can select any values from it. You can say fetch repo false, but transform data true and train model true if you slightly redefine the models. And that's what I have. I have a data repository class, so it's all using object-oriented programming, and I essentially call different Colabs that we were discussing at our sessions. So first I download the data and save it to the repository as a standalone Parquet files. Then I transform the data, so I may I get that data from the Parquet files, that is macro stats and stocks stats, and I transform it to one data frame. And then when I have the data, I train random forest and save the model to the folder, and finally I can reuse the model and make predictions. For example, later if I want to do predictions every day, I can download the latest data and do the transformations, but reuse the same trained model, so that we will have the predictions from the model that was trained some time ago. So latest step is making inference. I can start running it. So that's it, and it will start downloading stats here. I had to redefine the input sources that it tries downloading from Yahoo Finance, and then Stook, and then from Fred. So we can try it again in a few minutes. There is a file with all changes. You can read about all these changes, but it's a more powerful model because it has more data. Also, I had 2 workshops last year, and I think that's a great idea if you want to automate without infrastructure. That means that you don't need to create Docker images, you don't need to rent cloud computer. You can leverage GitHub Actions for running a workflow, and use Streamlit to do visualizations. So all workshops are public. Here are YouTube recordings, repositories, and dashboards. Let's look at say economic dashboards repository. You can see that I do not have any commits here, but bots GitHub Actions does it every week, and it creates a weekly economic data update. That's why if I open the dashboard, which you will see in a minute, I have the latest available data. The problem with this approach is that it saves all the data every week to this folder, and you see economics data DB, so it's SQLite database, essentially one file. And if you wanna clone this project, you will clone all the versions of this database file for every week. So this is not the most efficient way of using GitHub. You may need to run a cloud database, and you can do this as well. So my second project, it actually uses SQLite cloud database, and it's not saving the data here, but it's saving the data into the database, while the dashboard downloads data from the database. So that's the automation piece. I do not host any servers. There are limitations that you can't run more than 2,000 minutes a month or so, but my workflow spends only one minute per week. So it's a big threshold. And second, let's look at the dashboard. If you open it, so when you're using Streamlit, sometimes your dashboard can go off. That means that you need to press a button, and the system will download the GitHub repo and initiate the dashboard. So this is unfortunate because they are optimizing costs and they don't want to run all the dashboards that are not used by people. Here you can see that, okay, we ran this, and latest data was actually 1 week ago, July 25th, 2025. So it's a very fresh data. Interest rates, it's all visual, so that's you can have a really nice automation without spending too much time on infrastructure. You can just clone these repos and use the same idea. So the major idea is use GitHub Actions for automation. So you create a short script, and AI agents do this perfectly. When you have this main.py function, they will create a script for you. Use Streamlit, so you create a free account and you show the public GitHub repo that has the code and the data, or the code and a database, and that's it. That's the system that you have. Now let's talk about the most interesting part for you. So this is about the Capstone project. This year I have more things to show you than last year, because I have all Capstone projects from the last year, and the leaderboard is public. You can see it here, so that's okay. If you open this link, you can see there is a cohorts 2024 leaderboard projects. I manually checked all the projects, and here are the links to the repositories. And the time spent, it's a lot of information, whether they passed or no, the project score. You need to have at least 6 points to make the project pass. So okay, let's discuss in more details. First, about the requirements for the project. The requirements will be the same, so you can read about all of the requirements in the README file. The timeline is that you will have 2 weeks from approximately tomorrow, when I create a page for a project submission, to develop a project. So we have all individual pieces already. You just need to maybe define a different set of stocks, or different markets, or different model that you're most proficient with. So try to change it somehow and develop the best project that you can do in a limited time frame that you have. And then please remember that you need to peer review 3 other submissions to get the certificate. So it's not enough to submit your own project. You need to review 3 other submissions. There are evaluation criteria, and all those criteria are covered in readme.md, and the submission link will be published soon there as well. Okay, let's look at the criteria. So you can see the problem statement, deliverables, which files are recommended to include. Then there is a problem description. So, and the minimum action that you need to do is in bold. So you get 1 point if the problem is described in README briefly without much detail. But if you cover all the logics, you can get additional points. Then data sources, if you add more data sources, more features, if you have a big data frame like 1 million of records or so. Data transformations, if you show the exploratory analysis, if you create more variables during the data transformation stage, you get more points. Modeling, so we covered in detail decision tree and random forest. You may use any other models that you want. trading simulations, you can do only base simulations. You can do advanced simulations with daily row by row simulations, whatever you like. You can do a lot of things during the automation piece. We do not cover this in much detail because it will be another course. So I know that there are a lot of experienced software engineers here. It may be easy for you or easier. That's how you can get a lot of points. And I also defined a few bonus points that is subjective. And if you're reviewing other projects, please be generous. Try to understand if you see that the concept is new to you, that there are some great ideas in the project. Try to reward. And I have some ideas that are also not covered, but you can implement it in your projects, and you can grant those bonus points while peer reviewing. So here you have a project submission for 2024. I will create a page for a 2025 course, and I will notify you in Slack and Telegram channels and over the email that the project submission folder is open, and now you have two weeks to finish the project. For the leaderboard, I recommend you to look at a few projects, and I have tags for the project, so you can see how many stocks, which are the markets covered, what are the models like LTCM, what are the frameworks, whether it's PyTorch, TensorFlow, PyCaret. If there is an advanced automation, like here you see GitHub Actions, Docker, Cloud Deployment, and the dashboard, but negative average growth rate. So you can combine all of these solutions and have a great project for yourself. So if I were you, I would focus on something that is close to your heart and something that can bring you profits if you decide trading with your own money. So that's the recap for today. Home assignment number 4, we discussed the core ideas, and you were supposed to do small adjustment to the existing code, not ideal code, and run it again and tune the whole system. Then we spent a lot of time on the advanced simulation, how you could simulate the predictions from a model with features for trade size, entry price, stop loss, take profit, and selecting top K predictions. Then there was a discussion about automation, how we move all the Colabs to Python files, how we can develop locally using Visual Studio Code. And if you do this and you have notebooks, you need to run your Jupyter Notebook server as well. So we defined Python files with the stages and ran it from the main.py. And okay, we didn't schedule the data yet, but okay, that's the result. So I ran it manually once. You can see that it was downloading a lot of data. Then it made transformations. Then it said that we train a random forest of maximum depth 17 and estimators 200. That is 200 decision trees averaged. and that's the top, actually it's top 10 predictions for today. So okay, it's not only for the latest trading day, but for a few days ago too. But I would normally look at the latest trading day only. That's what you see. It's PCG, Walmart, and MMC, and that's the prediction probabilities. So when you have those, you can manually input your trades, or you can send it via API. You can also use this for the lowest prediction probabilities. So for today it was 45.45 for DHI, GEV, and USB. So if you want to combine long and short strategies, so buy highest predictions and sell lowest predictions to make a market neutral strategy, you can do this as well. So that's the output from the workflow, and you can save it to the database. You can send it to the dashboard or to the API directly. I'm still checking manually all of my trades and trying to understand what happens when my trade is terribly wrong. Of course, we don't expect 90% of them to be correct, but let's say 60% or 58% to be correct, and that's for sure. So if suddenly like 80-90% are not correct, something is happening, and you may need to adjust the overall process. And finally, so we discussed the Capstone project and the leaderboard from 2024. The final slide for today, there is no homework, home assignment number 5. Your goal is to start working on the Capstone project. So the evaluation criteria are published. The deadline will be shared soon, hopefully tomorrow. It will be 2 weeks of development and 1 week for peer review. You can get additional points for tagging Python West and datatalks.club when you create a project or submit a home assignment. I know it may be a great milestone for you if you create a project that is actually working. So please share with us, share with everyone, and we can check what you have. That's it, folks, for today. Thanks for listening, and see you next year. You will see a few updates from me very soon. Please check Telegram, Slack, and email, whatever you're using. And remember, if you don't have enough time, you will have a submission attempt number 2 this year as well. But please try to do something during the first attempt, because later you can improve your project always. So have a great week ahead, and see you next time.